Hello everyone, today we will discuss another topic of insurance law under banking and insurance law. Today we will discuss about kinds and principles of insurance. There are certain principles which are applied to the all insurance contract. We will discuss about that, and there are different kinds of insurance. We will see how many kinds are there. The list of topic to be covered here is we will discuss about insurance, certain definitions given by different author. We will talk about that. Then we will discuss how many types and kinds of insurance are there, and we'll discuss principle of insurance which applies to all insurance contracts. Insurance is an important aid to commerce and industry. Every business enterprise involves large number of risks and uncertainties. It may involve risk to premises, plants and machinery, raw material and other things. Goods may be damaged or may be destroyed due to fire or flood. Some risks can be avoided by timely precautions and some risks are unavoidable, and those risks are beyond the control of a business. These unavoidable risks can be protected by the way of insurance. Every risk involves the loss of one or other kind. In older time, the contribution by the person was made at the time of loss. Today, only one business which offers all walks of life is insurance business. Owing to growing complexity of life, trade and commerce, individual and business firms are turning to insurance to manage various risks. Every individual in this world is subject to unforeseen uncertainties, which may make him and his family vulnerable. At this place, only insurance helps him not only to survive but also recover his loss and continue his life in a normal manner. Different authors have given different types of definitions, and they have made an attempt to define insurance with different aspects. We have different definitions from certain different authors. First of all, Dr. W. A. Dinsdale, he has given definition of insurance and defined insurance as insurance is a device for the transfer of risk of individual entities to an insurer who agrees for a consideration called the premium to assume to a specified extent losses suffered by the insured. Another definition is given by Professor D. S. Hensel: a social device providing financial compensation for the effects of misfortune, the payments being made from the accumulated contributions of all parties participating in the scheme is called insurance. Now, A. H. Willett has defined insurance as insurance is a social device for making accumulations to meet uncertain losses of capital, which is carried out through the transfer of risk of many individuals to one person or a group of persons. Professor Alan L. Meyerson has defined insurance as insurance is a device for the transfer to an insurer of certain risk of economic loss that would otherwise be borne by the insured. Now, let's talk about how many different kinds of insurance are there. The following are the various types of insurance businesses recognized under the Insurance Act 1938. Life insurance business, general insurance business, which is also called as non-life insurance business. Further, this subdivided into following three categories. General insurance is divided under fire insurance business, marine insurance business, and miscellaneous insurance business. Now let's discuss about certain principles of insurance which applies to the all insurance contracts. These principles are the basic necessity of insurance contracts. These are the certain elements which are necessary and mandatory to be present under insurance contract. Without these principles, insurance loses their actual entity in the commerce and trade market. The basic principles which govern the insurance are: first, utmost good faith, insurable interest, principle of indemnity, principle of contribution, principle of subrogation, causa proxima principle, and the principle of mitigation of loss. Now we will discuss all these principles in detail. Let's start with the first principle, which is of utmost good faith. A contract of insurance is a contract of urbime fidei, that is, utmost good faith. Both insurer and insured should display the utmost good faith towards each other in relation to the contract. In other words, each party must reveal all material information to the other party whether such information is asked or not. There should not be any fraud, non-disclosure, or misrepresentation of material facts. Another principle is insurable interest. This principle requires that the insured must have an insurable interest in the subject matter of insurance. Insurance interest means some pecuniary interest in the subject matter of the contract of insurance. Insurance interest is that interest when the policyholders get benefited by the existence of the subject matter and loss if there is death or damage to the subject matter. Basically, insurable interest is the interest which the insured has in the particular thing, business, or the subject matter of the insurance contract. It could be a life of a person, or any property, or any business owned by the insured. Next is principle of indemnity. This principle is applicable in case of fire and marine insurance only. It is not applicable in case of life, personal accident and sickness insurance, that is medical insurance. Contract of indemnity means that the insured, in case of loss against which the policy has been insured, shall be paid the actual cost of loss not exceeding the amount of the insurance policy. The purpose of the contract of insurance is to place the insured in the same financial position as he was before the loss. Indemnity or indemnify means to restore the status of a person as before he has suffered the loss. So, the insurer was supposed to restore the actual status of the insured as if he does not have suffered any loss or damage during any accident. Next is principle of contribution. The principle of contribution is a corollary to the doctrine of indemnity. It applies to any insurance which is a contract of indemnity, so it does not apply to life insurance. A particular property may be insured with two or more insurers against the same risk. In such cases, the insurers must share the burden of payment in proportion to the amount insured by each. If one of the insurer pays the whole loss, he is entitled to contribution from other insurers. Basically, the business of insurance was uh, is basically it works on the principle that all the risk has been divided among the large number of people. So there is a method which is used by the insurers to indemnify the insured in case of any loss or damage caused to him. All the payments and burdens shared by the insurers so that the loss could be paid to the insured. The principle of subrogation. It is an outcome to the principle of indemnity and applies only to fire and marine insurance. According to the doctrine of subrogation, after the insured is compensated for the loss caused by the damage to the property insured by him. The right of ownership to such property passes to the insurer after settling the claim of the insured in respect of the covered loss. This principle was included here because as soon as the insurer pays the loss amount to the insured, the damage caused to the business or property which was insured by the insurer goes to the insurer as he has already paid the loss for that particular property. And after settling the claim, the insured does not have any ownership on that particular such property which was destroyed. So the whatever is left in that particular property belongs to the insurer as he has already paid the law or amount to the insured for that property. Next principle is of causa proxima. Causa proxima means proximate cause or cause, which in a natural and unbroken series of events is responsible for a loss or damage. The insurer is liable for loss only when such a loss is proximately caused by the peril insured against. The cause should be the proximate cause and cannot the remote cause. If the risk insured is the remote cause of the loss, then the insurer is not bound to pay compensation. The nearest cause should be considered while determining the liability of the insured. The insurer is liable to pay if the proximate cause is insured. Here, the proximate cause could be those unbroken series of events which is responsible for causing the loss or damage to the property. There should not be any remote cause. That means whenever a property or any uh, uh, whatever the subject matter of the insurance contract is being destroyed by any cause or any reason, it should be destroyed or damaged uh, as per the happening of a series of events. There should not be any break in between the series of the events. That only could be considered as the proximate cause for causing loss or damage. Next is mitigation of loss. An insured must take all reasonable care to reduce the loss. Mitigation of loss and the word mitigation means to reduce. So here the insurer has to take all the responsibility to reduce the loss which is caused to the insured. We must act as if the property was not insured. Example: if a house is insured against fire and there is accidental fire, the owner must take all reasonable steps to keep the loss minimum. He is supposed to take all steps which a man of ordinary prudence will take under the circumstances to save the insured property. Here we can say that if any person has insured any property and in the events of the accident which is causing damage to the property, the insured person cannot stay careless about that particular accident. He has to take all the reasonable cares to stop that particular damage or the accident which is causing damage to the property. He has to act as if the property or the particular thing is not insured, and he would have to suffer all the cause or loss which is caused to that particular property by any accident. So this is the principle of mitigation of loss.